Good evening, everyone. How's everyone doing today? All right, so a couple of you have been preparing VITA returns for the past couple of years. Some of you, this is your first time coming out and volunteering. So what we've usually started with in all past years is we kind of came up here and said there's not really a whole lot that's changed in the past. But for those of you who've been paying attention over the past year, there are a couple significant tax changes this year that we want to cover. So for those of you who have been volunteering for a while, we'll be talking about a couple new items, some things that may or may not be as important as they have in the past. Particularly as we take a look at the next few weeks, talking about items of income, deduction, credit that may have changed over the past. For those of you who have never done it before, you've never seen a 1040, you don't need to worry about what the old one looked like. We'll kind of teach you all the new stuff right from the very beginning here. One of the first questions we usually end up with here with tax return filing is who has to file an income tax return? And again, as Steve mentioned, we're going to see some slides behind me here. In the upper right-hand corner will be a page reference number to your 4012, which they hopefully explained is not yet available for print coming out of the VITA program. They will be available, I believe, in January. If you would like to get an advanced copy, you're more than welcome to go ahead and print one off the internet. I have a copy down by my feet here, which you can see is about a whole ream of paper on double-sided pages. So if you'd like to wait for the tabs to come out, that'll be available in January. But you do have access online if you'd like to take a look at that under the IRS Pub 4012. One of the first things we talk about is who is required to file an income tax return. And there are three things that we need to know about taxpayer status before we can determine if they need to file a tax return or not. The first two are going to be fairly easy. We don't actually have to do much information. The first one's going to be age. And for those of you who are first-time preparers, you do need to find out how old they are. You don't have to ask height or anything else, their favorite color. We do need to get their age though. So that's going to come off their Social Security information, their basic background information. We need to get all of that. But once we determine the taxpayer's age, we can determine whether or not they have a filing obligation based on their gross income and their filing status. And tonight we're going to be talking a little bit more about filing status, the 5 different options that we have in terms of whether or not the individual is required to file a return. What we're going to see on the chart behind us here is some information and really taking a look at predominantly what is going to be our new standard deduction levels. So these have increased dramatically from last year. So the standard deduction for a single individual is $12,000. So if an individual is single and makes less than $12,000, they do not have an income tax responsibility. If they are single and they are either age 65 or older or they're blind, they get an additional $1,600 addition to their standard deduction. So that's why you see on the chart behind us, there's a $13,600 threshold for someone who is 65 or older. We'd add another $1,600 to that if they are blind. For a married couple, that's now actually jumped up to $24,000, exactly twice the amount of what we have for individual taxpayers. Now, the only difference is that their additional dependency or their additional standard deduction is only $1,300 for age 65 or older or blind. So they don't have quite the same benefit as they do if they're unmarried, but it is still increasing. We'll talk a little bit more about some of the different statuses, but you'll see one up there that says married filing separately. That's the one that has the lowest threshold. We'll talk about what that filing status is, and you can probably have a pretty good guess. That's not a good one to be at. If you have $5 of income and you're married filing separately, you're going to be required to file an income tax return. In addition, we have some other status opportunities. The head of household is a very popular one. You may have heard about that one before. You may have a lot of clients that have also heard about it, and they're really interested in what the head of household is, and they would like to find out if they qualify. So we'll talk about more of that filing status. That is a fairly nice ability as well. It's about 50% higher than the single filing status. You get an $18,000 standard deduction. And again, that's going to be $1,600 for age or blindness. One of the other areas we'll see, probably very rare, we have seen it a couple times here within VITA, is a status called qualifying widower with a dependent child. And we'll talk a lot more about this status, but it's effectively the same standard deduction as a married filing jointly couple. So it's actually twice the amount of a standard deduction for singles. Now, we go through the chart, and the main reason we go through this is not to tell people, yes, you have to come into VITA. Generally, we encourage everyone to come into VITA. We'll talk a little bit more about how we can benefit those that don't fall in these qualifications. One of the reasons I want to show you this chart is because when you take your VITA exam, a lot of the questions that they'll start off with is the following scenarios. Which of the following taxpayers are required to file an income tax return? The decisions that we need to make as preparers is basically what filing status should we use? The rest of the information is going to be coming out of either documents provided by the government or the client, and their age, which they really can't change. They can lie about a little bit, but we know how old they actually are once we see their documents. So those things we can't change. What we're going to be taking a look at here is how we're going to determine filing status and what are the other options. Now, when we talk about gross income, it doesn't mean all the income that they have. It's essentially going to be a component of taxable income. So when we take a look at these, you may have individuals that collect Social Security, but we're not looking at all the Social Security that they have. It's only going to be a portion of that that'll be subject to taxation, but we don't need to go through the calculations. The most important part about preparing returns is a tax program that we use and we mostly enjoy working with. There are a couple hitches here and there, but it does all the work for us. We don't have to memorize tax rates. We don't have to go through and do manual calculations. It's going to put the information exactly as we need to see it. So as long as we have the information entered correctly, it's going to go through and do the calculations for us. Now, in addition to who must file based on the chart, based on your filing status, based on your amount of income, based on your age, there are a couple other special circumstances that may require a taxpayer to file. Predominantly, one of the reasons that we have to file would be if they're in a situation where they are self-employed, if they are in their own business. And we tend to see a little bit more of that in VITA. Over the past couple of years, we're starting to see a few more people come in that might have a small side job, driving for a ride, sitting, or any other type of services. If they have $400 or more of earnings from that occupation, they're going to have to file an income tax return. That's going to be subject to self-employment tax in addition to income tax. In addition, we may see some taxpayers that have premature distributions from a retirement account. So if they're taking money out of a retirement account, whether it's a SEP, an IRA, 401k, and they're not at retirement age, they're going to be subject to an additional penalty on top of the taxation. So if anyone has a withdrawal from a retirement account and it's earlier than expected, we do have to file an income tax return for them. The next situation we don't see all that often, but I believe there are a couple of people in the VITA process still that have a first buyer repayment. It's a credit that had occurred almost a decade ago at this point, that the government had allowed first-time home buyers to get a credit. They were the ones that did it right away. They got the credit. They had to repay theirs. If you got your credit a year later, it's not repaid. So those people who got it early had to repay that credit back over a period of time. We're in the tailing ages of those credits, but if they do have to repay it back, they're going to be well aware of it. They do need to file a return as well. If individuals have received distributions from certain types of accounts, and we're going to look at certain ones, in this case, it's going to be a HSA, a health savings account, or an Archer MSA, or a Medicare Advantage MSA. These would also be requiring us to file an income tax return, because there can be additional taxes and penalties if the funds were not used for the appropriate purposes. The last one we want to take a look at is one that we're going to be seeing here in 2018 and possibly going forward as well, even though we're going to see some changes with the Affordable Care Act. One of the issues that we have with individuals who have signed up for insurance through the marketplace is they have an opportunity to get what is called an advanced premium credit on their insurance premiums. And typically the way the credit is based is that you will go through and notify the marketplace of how much you believe that you will have in income. The income determination will then calculate a credit. That credit will be applied to your monthly insurance premiums, and that is considered an advanced premium credit. If the taxpayer has received an advanced premium credit, they have to file an income tax return for the year. If they don't file by the due date, they will get a warning notice to say that they have to file that return. The IRS needs that information to recalculate to determine whether they receive the appropriate advanced premium credit or not. So if they do have marketplace insurance, they do need to file an income tax return if they've taken the advanced premium credit. Okay, so getting to the ones that have to file based on age, based on filing status, based on income, the ones that have to file because of either special taxes or distributions, or that they've taken advantage of a couple government programs, we really get to the whole concept of who should file. And talking with the VITA administration, everyone should file because we want to stay busy during tax season, right? We want to make sure that we're not sitting around bored with nothing to do during February and March. But when we take a look at the who should file, it's really a lot of individuals. The only way that you can get money back from the government is to tell the government how much money they owe you. No one's actually had the government just write them a check to say, we think we owe you a couple $1,000s, here you go. That should probably take care of things. We need to actually go ahead and file an income tax return. And it's going to be critically important if individuals have had tax withholding, whether from wages, Social Security, retirement plans. The only way to get your withholding back is to file a return. Quite often we'll see children of taxpayers that may have had a small part-time job. A lot of those individuals have filled out W-4s that have taxes withheld from them. Going forward now, they should probably fill out their W-4 as being exempt from tax, but the only way you can get that $17 refund back that was withheld from your part-time job is to file a 1040 or a 1040 EZ. So the only way to get that refund is to actually go ahead and file the return. Likewise, if they made any estimated payments, if they may have had a credit carryover from a prior year, the only way to get that refund is to file the return. A couple other situations we can take a look at. Even if they did not have any tax withholding, there are a number of what we call refundable credits, and we'll cover these in our third area. So give you something to look incredibly forward to after Thanksgiving. So next week income, then everyone has a nice big meal, then we come back the following week when we get to talk about how we get credits and deductions. So the credits are refundable in certain cases. We're going to have talk about the new child tax credit, which has been expanded. So not only do we see some applicability here in the VITA program, but also there may be some information that you can take back. So if you want to read ahead, so when people ask you at Thanksgiving, what are you doing next winter? And you mention you're going to volunteer for income taxes, and all of a sudden, the conversation changes. Everyone now has questions for you about what the new tax law means. We're going to try and get you as much information as possible, but one of the questions is probably going to be around the new child tax credit. One of the biggest ones we're going to see is the earned income credit. The most powerful credit we'll see, it benefits people who are working, who are relatively low income individuals, and depends on if their age and how many children they have. But we've seen some substantial credits coming out of the earned income credit. The only way you can apply for the credit is by filing an income tax return. So in addition to the child credit, in addition to the earned income credit, there are a number of other very popular ones, the American Opportunity Credit, one for individuals in their first 4 years of college that is partially refundable as well. So even if you have no tax liability, you can still get money back from the government. One of the other ones that we'll see at some of our sites, we may have some seniors that don't have a federal or state or even local filing responsibility, but we can assist them in other matters, such as the PA property tax rent rebate claim. So that is a very popular option for individuals to come in. We can make sure that they have their returns filed and then also take care of the property tax rent rebate program for them. So another benefit for them to come into the service. Okay. So one of the other things we've talked about in the past is we had kind of this long discussion about personal exemptions and who qualifies for personal exemptions and going through a lot of those questions. But the new tax law has basically suspended any personal exemptions until 2026. So for those of you who have been volunteering for a while and you've been trying to figure out how many personal exemptions do we have, just table that. In 2025, we'll go ahead and we'll talk about that again, that you need to be ready in 2026, that it's going to happen again. Now, that's assuming we don't have any tax law changes in the next 8 years. I'm pretty sure we'll see some changes happening. So just as another aside, just to let you know, I've been in practice for over 20 years, but I tend not to memorize any numbers. Why? Because they're always going to be changing. So there are a couple things that we want to try and keep in mind. So if you ask what was the exemption rate in 2008, I'll have no idea what it was, but I'll know what an exemption is. So what we're trying to teach you is how do we understand what the tax law means. But we don't have to worry about personal exemptions anymore. That was having the ability to decide whether or not you could claim one for yourself. If you're married, you had one with your spouse. Spouses were never dependents. They were always equal in terms of tax views. And then we determined how many dependents you'd have. Now, it's not to say that dependency doesn't matter anymore. It is still going to be an important determination for us for a variety of reasons. One is if an individual is filing an income tax return, we need to determine whether they're eligible to be claimed on their parent's return or someone else's return. So we can't just have someone come in and say, I'm going to go ahead and file an income tax return and I'm going to take a claim myself. If they're eligible to be claimed as a dependent, which we'll be talking about in just a little bit, they may not go ahead and take themselves as a dependent. And what it's going to be impacting is not necessarily their income tax liability, but their ability to take credits, things like the American Opportunity Credit or other credits that they might be appropriate. So we do have to make sure that we're going to determine if they're eligible to be claimed as a dependent on someone else's return, they may not take themselves and be eligible for those credits. So that's one of the things we still want to take a look at for purposes of personal exemption. We don't have a dollar figure for those anymore, but we do have to determine where the individual should be claimed. And that kind of leads us right into our next area, claiming dependents. This is one of our biggest areas that we are going to take a look at. The main issues that we're going to be taking a look at tonight are going to be dependency exemption and also filing status. So dependency we're going to start off with first. Again, to reference, we're in the 4012. Once you get your 4012, it'll be chart C1, also available in your materials, to determine who would be qualifying as a dependent on an income tax return. Now, a couple things that we need to keep in mind. So in order to be able to claim a dependent on your tax return, you yourself cannot be dependent of someone else. And it kind of makes sense. So if you're dependent upon someone from a tax situation, you can't be providing support for someone else. The IRS does not allow someone who's claimed as a dependent to again take a dependency for someone else. So we can take a look at some options that can work out in that situation. We have seen some scenarios in the past due to living arrangements. You may have multiple generations living under one roof. If a child is claimed by the parent as a dependent and there's a grandchild in the picture, the grandchild will not be able to be claimed by the parent, but may be able to be claimed by the grandparent. We'll kind of talk about some dependency rules there. So first rule, you cannot take a dependent exemption if you are yourself a dependent of someone else. The other situation we run into is who would be a qualifying dependent. So the individual that we're looking at has to be either a US citizen, has to be a US national, US resident alien, or a resident of Canada or Mexico. They do not need to be a US citizen if they are living in Canada or Mexico as a resident. So we don't see that quite as often here in Lancaster County, Mid-Penn area. But if you do have individuals that are married and living up in Canada, technically their children, their spouses can count as qualifying for these credits here because they are residents of Canada. One issue we also take a look at is your dependent cannot be married. So we kind of take a look at it and say, well, that sounds odd. Why would we ever try and claim a dependency for a married individual? If I have a 13-year-old child, I'm pretty much presuming they're not married. And that's true. You can actually take a dependency exemption for a married child in a specific circumstance if they're filing a return only to receive a refund with their spouse. And we don't normally see it in this area, but you often have it where you may have individuals who are looking at getting married before their spouse heads off to the military or off for service. So you may sometimes see individuals or before they head off to school decide they want to get married. The child is still living at home, they're still dependent of their parents, but yet they're married under state law. So as long as they're filing a tax return only to get refunds back, only to claim the amount that they had withheld, they can still be a dependent of their parent. So again, not something we see very often. I probably wouldn't get too concerned about this in actual practice, but just watch for the VITA exam. Sometimes they throw out these little unique scenarios. I'm pretty sure they're not going to throw out a scenario to say, you know, Susie is 13 years old. She's been married for 7 years. She is filing a return with her spouse only to get a refund back from the lemonade stand she worked at over the summer. You don't need to worry about that. But just one of those scenarios to say you cannot be married and still be considered a dependent. Now, when we talk about dependencies, there's two different rules we're going to look at. One is going to be a qualifying child, and the other one's going to be a qualifying relative. And for those of you who believe you understand the English language fairly well, just be prepared, because when the IRS has written their tax regulations and rules, they will put out unique definitions that don't necessarily kind of follow what our belief is of what we consider a child or a relative. So just warning you up front, and we'll see this a lot more as we walk through the tax code. But the first thing we're going to be taking a look at is a qualifying child. Qualifying child is our primary method of determining whether or not an individual is going to qualify as a dependent. And there are some very specific rules for a qualifying child. We're going to take a look at a couple different circumstances. One is what we consider the relationship test. And if someone said, is that individual your child, we kind of have our own mental picture of what that would look like. Someone who's probably an offspring, maybe someone who's adopted or a foster child. And all those are valid until we get to the IRS definition of what a child would be. We're looking at a child, sounds good so far, stepchild, still pretty good, foster children, adopted children. And then we get into this other category, the second line, your brother, your sister, your stepbrother, your stepsister, or descendant of any of them. So what we're taking a look at is your lineage. So you're going to go from yourself and you're going to look down. So it can be your children, your grandchildren, your great-grandchildren, your great-great-grandchildren, however many generations you have. And then we go across. It's going to be your brothers and sisters, and then we go down from there. So it can actually be your nieces and your nephews and any of those descendants. So your great nieces, great nephews are really what we consider a child definition. And we'll kind of explore that a little bit more because we need to determine a couple other factors. So in addition to the relationship test, we're also going to be taking a look at the next one being a age-based test. And the age-based test is essentially going to start with the child has to be under the age of 19. And just watch, because the IRS loves to put these little word tricks in play here too. Sometimes they'll mention something under a certain number. In this case, they have to be under the age of 19. So for those of you good at math, that means 18 or under. So we'll do the little greater than or equal to or less than signs here. Sometimes they'll just use a number. And instead of just saying it's less than 14, they'll say it's the age 13. Okay, great. So just be aware sometimes the tax will kind of change its definition. So the child has to be either under the age of 19, and if they are your qualifying child, they have to be younger than you. And you may say, why do they have to be younger than me? That sounds kind of odd. I would not expect my child to be older than I am. What they're looking at is really the whole situation with brothers and sisters. So we may have some situations where you have a sibling group and the parents may not be in the picture. You may have an older sibling taking care of younger siblings. And that would be a situation where they can actually claim their younger siblings as qualifying children for purposes of tax return, as long as those qualifying children are younger than they are. So the first age test is going to be under the age of 19. But then we take a look at another definition. If they are a full-time student, they can be under the age of 24. And now we take a look at another definition. What would we consider full-time? If you're thinking employment, you're probably thinking at least 32 hours a week, probably 50 weeks a year. The IRS definition of a full-time student is that you are at least a half-load student at an institution. So the institution is going to determine what they consider a full-time student. So as long as you don't fall beneath that category, as long as you don't fall beneath their half-time status, you're considered a full-time student. And you would tend to think, sure, okay, that's great. So now we need to be enrolled in school for the entire year, right? No. You only need to be in school for any part of 5 months out of the year. So when we think about people who are off to, say, college, what we're looking at is a typical spring semester will probably start in January, go through February, March, April, and then probably end up leaving sometime early in May. That's still 5 months, even though we don't have a full month in January, a full month in May. Same thing in a fall semester. If they're starting in August, they're still going to have 5 months worth of education. So the full-time definition is not necessarily full-time. So you're looking at any part of 5 months over the course of the year and at least a half-time basis. The other issue we take a look at with age, if the individual that we're looking at is completely or totally disabled, they are still considered a qualifying child of the taxpayer. They can be any age. And I've worked with an individual who had a sister who was permanently disabled, and he was able to qualify her as a qualifying child for purposes of the tax code because it meets the definition of the sibling. She's totally and permanently disabled. He provided her support, and she actually lived with him for more than half the year. And those are a couple other tests that we're going to take a look at. So the first one, relationship. Second one is age. The third one is going to be taking a look at where they're living. So they have to be living with the taxpayer for more than half the year. And now what we take a look at for that living situation, it doesn't necessarily have to be under your roof at all times. If you have a temporary absence, and the IRS will allow temporary absences for things like education. So if you're away at school, that would count. If you're on vacation for more than half the year, that counts as well. If you want to take a gap year and go find yourself somewhere out in the Midwest on a motorcycle, that counts as well. It's a temporary absence. If you're incarcerated or in a treatment facility, those count as temporary absences as well. So it doesn't have to be an entire 12 months, so as long as the absences are considered temporary. So the living arrangement. The interesting part here, we're going to come up with this definition to say the child themselves cannot provide more than half their support. And by support, we're looking at the means to survive, the ability to feed themselves, clothe themselves, transportation. As long as the child doesn't provide more than half their support, then they still meet the definition of a qualifying child. The definition here doesn't say who has to provide the support. It just says the child can't provide more than half. So it opens that up quite interestingly. Again, we have the whole thing about the joint return. So that'll pop up yet again. The IRS wants to be sure you're well aware of the fact the child can't be married unless you're only filing a joint return to get a refund back for taxes paid. Now, what the interesting part with the qualifying child is going to help us take a look at a variety of things. It's going to set up our ability to take things like a child tax credit, education credits, child independent care credits, a bunch of other things. So the IRS has already kind of identified that there can be some issues, that maybe we have some situations where more than one person can take a child as a qualifying child. And unfortunately, we do see that circumstance happen. Generally, when we go through the VITA process, we want to be sure that we're getting the qualifying child to the right individual on the return. However, there may be some situations where there will be multiple people who could try and claim someone as a qualifying child. What will happen is the first person who claims the child and they file electronically will get the automatic dependency exemption. The second one will get a reject notice to say the dependent number has been used on a return. Our solution, if we actually believe it is a qualifying dependent, can file a paper return and we'll let the IRS sort it out. They have their own specific regulations of how they'll go through determining who wins in a tie-breaking scenario. And we actually have a chart that we're going to put on the screen here. It's also in your 4012 on C2 that'll help us determine who actually wins in a tie-breaking scenario. So if we take a look at a qualifying child, if more than one person is trying to claim the qualifying child as their own dependent, and only one of the individuals who's trying to make that claim is the parent, then by default, the parent's going to get the dependency exemption. The next scenario we take a look at would be if both parents are trying to claim the child. And again, for the IRS, they want to be very clear that if you're filing a joint return, that there's no problem with both parents trying to claim the child. So they kind of get to the situation, it's kind of a unique approach that they have to remind you that if both parents are claiming or trying to claim a child and they're filing together, there's no discrepancy, there's no problem there. So if both parents are trying to claim the child and they're filing separate returns, the dependency exemption is going to go to the parent who's had the child for the most amount of time throughout the year. So they're going to go effectively on a custody type arrangement. Now, one of the reasons we want to point this out is for twofold. One is we have to determine where the child lived for the majority of the year to find out which of the parents would have the primary claim. The other situation why I want to point this out is for situations of divorce. We do have a couple individuals within the VITA program that have gone through divorce proceedings. Quite often you may see a divorce decree that will say that if a child is a non-custodial child, that the dependency exemption will go to that non-custodial parent for certain years. The important thing to remember is that it doesn't matter what the divorce decree says for the IRS's purpose. The IRS will default back to wherever the child lived for the majority of the time. So if the custodial parent tries to file a return, even though they're not supposed to take the child as a dependent under the divorce decree, the IRS will still give them the dependency exemption because the IRS rules will supersede the divorce agreement. What's important for people to know if they have a divorce decree that they need a form signed by the ex-spouse. It's a form 8332, which will lay out the years in which that the ex-spouse can claim the child. So it'll be something to kind of keep in mind. I don't believe we've seen it often in VITA, but it is just one area for protection. If you're going through the process, the form 8332 would be important to have. Probably not surprisingly, the easiest time to get that form signed is during the divorce itself when you're going through property settlement, not a couple years later when the individual says, oh, by the way, in order for me to take the child for dependency exemption as we agreed to, I just need you to sign this form and then I can get a lot of money back on my tax return. Generally not the easiest time to do that. They can actually sign it in advance and specify the years in which that would happen. So you don't have to go back and get it signed each year as long as you have one copy. That would be sufficient. Generally, the IRS would like to see a copy of that attached to the return. If you don't attach it to the return, at least be sure the client has a copy that they can produce in case there becomes an issue. Yeah. So that's one situation we run into. If both parents try and claim, the IRS will generally default to the individual where the child spent the majority of their time. Now, if we have a situation where the child spent an equal amount of time with both parents, then the IRS is going to determine whichever parent had the highest adjusted gross income. Who had the most income? That's the individual who's going to get the child for that tax year. So that's where we kind of go through the parent situation. Now we get a little bit more unique. So if we have a situation where no parent has claimed the child, Then what the IRS will default to is whoever next in line is trying to claim the child, they will go with the highest AGI, the highest adjusted gross income, whoever's made a claim for that child. So they'll basically collect all the information. Whoever had the most income for that year will get the child. And we'll go through a couple examples at the end of the presentation tonight that'll help illustrate the issue of who would be able to claim a child as a dependent. Now, one important note here as well. Because we said the parent has priority over any other individual to claim the child as a dependent. If the parent could claim the child, but chooses not to, and there may be a variety of reasons why they don't claim the child, maybe they're not getting a tax benefit from it, maybe they don't have any taxable income. If the parent does not claim the child as a qualifying child, someone else may be able to claim that child. The only thing that they need to have is they need to be sure their adjusted gross income is higher than the parent. But we have seen that situation before. Again, we may have some unique circumstances where an individual is living with, an individual may have a child, they're living with their parents, and they choose not to take the dependency exemption. The grandparents can take the grandchild as long as the parent doesn't claim, and as long as the grandparents have a higher adjusted gross income than the parent. Okay, so that's our qualifying child rules. Now we'll get to a unique aspect that we're going to call qualifying relative. And I say we're going to call it qualifying relative because we're going to change your definition of what you thought a relative was. When we go through the process, what we're going to see is there's going to be a flow chart on C4 of your 4012. I really would prefer to see the flow chart in reverse order. I'd love to see the first item that we ask is, did that individual have gross income higher than $4,150? Because that would stop the process pretty quickly. That actually falls down a little bit lower in the flow chart, I believe. So you go through the whole process and people get excited. Because when we start talking about qualifying relative, the first definition we have is someone who's not even related to you, which is a bit ironic when we talk about qualifying relative, and we're going to talk about someone who has no relation to you whatsoever. You can actually take someone as a dependent exemption. Now, again, we're going to see this mitigated a bit because we no longer have personal exemptions. So I don't think we're going to see this quite that often in VITA for the next couple years. Because a individual who's not related to you will not give you access to head of household status. It will not give you the ability to take a dependent or the child tax credit for these individuals. So I think we may see this a little bit less than what we've seen in the past. But theoretically, if you have an individual not related to you living in your house for the entire year, they could be a qualifying relative. So the trick that we take a look at, it has to be for the entire year, and we have to take a look at some other income items. But let's just say, for example, that someone has been living on your couch since the beginning of the year. We're taking over a spare bedroom. And you're getting toward the end of the year and you realize, it'd be kind of nice to get my living room back again. You may want to wait until after December 31st before you ask them politely to leave, because you may have the opportunity to claim them as a qualifying relative for the year, as long as they're there for the entire year. So if they've been with you this long, you might as well hold out for another 6 weeks and see how it goes. But one of the issues we take a look at, again, they don't actually have to be related to you. But now the next definition we're going to take a look at, I believe, is brought to you by Ancestry.com. Who have you ever met that you might possibly be related to? So the definition, we're going to take the child definition that we thought we understood what a child was, and now we're going to expand that quite a bit. When we take a look at the definition of a qualifying relative, we're going to start with the same basics as a child. So we're going to take a look at your child, your stepchildren. We're going to take a look at some other options here as well. Eligible foster children, great-grandchildren, grandchildren, great-great-great-great-grandchildren. We're also going to take a look again at your brothers, your sisters, your half-brothers, your half-sisters. We're going to take a look at step-sisters, mothers, fathers, grandparents, fathers-in-law. So we're basically looking blood and marriage. We're kind of going out, we're going up. So anyone you're descended from, any of your ancestors would qualify. So your parents, your grandparents, your great-grandparents could all be qualifying relatives. The only one that doesn't count is a foster parent. They're not considered part of that chain. So then we go across. Your brothers, your sisters, your in-laws can all come down from there as well. So their offspring, so your nieces, again, nephews, grandnieces, grandnephews, the only one that's carved out are cousins. So ironically, they don't quite fall into the whole tree of where we're at here. But I always like to say, if there's someone that you might see in 2 weeks at your dining room table for Thanksgiving dinner, there's a good chance that they're probably going to be close enough to be considered a qualifying relative in some manner or another. It's a very broad definition. So when we take a look at that prospect of understanding, first, do they meet the relationship test? Are they either someone who's lived with you all year, or are they someone who's related to you in some category of either blood, marriage, or a combination of both? Now, the biggest test we take a look at here, again, is this gross income of less than $4,150. This is our what would have been the exemption amount for the current year. It's what the IRS is going to base the gross income on. So you got kind of excited. You talk to people about, do you have any dependents? And they say, well, yes, I know last year we went through this whole process, and I brought my entire family tree with me to find out who I can claim this year on my return. Well, again, we're not going to get much of a benefit for it anymore. We don't have any personal exemptions, so you're not really going to have a benefit for adding a C attached on the front of your return saying how many dependents you have. But the main thing we have to take a look at is, do they have a lot of income? If they've made more than $4,150 or have more than $4,150 in gross income, they're not eligible to be a qualifying relative. So that's usually one of the tests that will kick a lot of people out of that definition. One of the other changes that we have is that the taxpayer also has to provide more than half the support. If we go back to the qualifying child definition, it was simply the child couldn't provide more than half their support. Now in the qualifying relative test, you as a taxpayer have to provide more than half the support. So that's going to be a clear indication. In this case, the IRS doesn't need tiebreakers because only one person can provide more than 50%. So that's one of the issues we're going to take a look at with a qualifying relative. Okay, so we're feeling pretty good about definitions and completely redefining what words mean, right? All right. So now that we've gone through dependency, and again, the qualifying child is probably going to be our primary one we're going to look at. That's going to be our main driver for a number of credits, a number of other opportunities on the return. The other thing we're going to be taking a look at, the other decision that we need to make in preparing returns is going to be filing status. And we have 5 different filing status or statusi. So now I've completely lost the English language as well. But we have 5 different filing options we have for a filing status. We're going to talk about single, we're going to talk about married filing jointly, married filing separately. We should probably star this next one, head of household. It's one that everyone loves to be able to be considered. And then we have the rare one, the qualifying widow or widower with a dependent child. Now, this is probably one that you may want to be able to walk through. We do have some resources for you in the 4012 handouts that you have there, at least to select pieces. Also, if you take a look at your other resources, they'll have a lot more information on filing status themselves. So there's some decision trees as well as a B6 in your handout. So we'll kind of start on an easy basis and work our way up to the next couple levels. So the first definition we're going to take a look at is single. And single for IRS purposes means as of the end of the year. We're going to measure this as of December 31st. You were unmarried. So fairly cut and dry. You were not married as of the end of the year. Doesn't matter what your Facebook status says, you know, it's complicated, you know, in a relationship, whatever else. As long as you're not married at the end of the year, you're going to be considered single for IRS purposes. Now, there may be a few other filing status that may be more beneficial than a single, and we'll talk about those in just a second. But if you're not married as of December 31st, if your divorce was finalized on December 30th, you are unmarried, you are single for the entire year. So what we're basically looking at here, we may have situations where an individual come into VITA and you ask, do you have a spouse that you're filing with? And they say, well, I have a spouse. You say, oh, okay, can we talk about that information? And they say, well, George passed away in 1973. Okay, well, we're not going to file for George anymore. George is no longer a taxpayer for U.S. purposes. You're also not a widower anymore for purposes of the Internal Revenue Code. You're considered single. Now, there may be some exceptions we talk about if your spouse has died in the current year. We'll talk about a special qualification for the qualifying widower. But if a spouse has died before 2018, the individual will most likely be single as long as they didn't remarry. So they may consider themselves as eternally married, and that's fine. But for tax purposes, they're going to be a single classification. Now, the next status we're going to take a look at is married filing jointly. And this is going to be our definition if you are considered married by a legal source by the end of the year. So by state, by government, as long as you are married by the end of the year, you are going to be considered married filing jointly. That's going to be your first option. So that includes if you're married and you're living together. That includes if you're married and you're living apart. Even if you're going through a process of the divorce or separation and it's not finalized yet, you're still married under tax law. So we have to take a look and ask, are you legally married as of the end of the year? If the answer is yes, then married filing jointly is going to be our first status. And there may be some options we can take a look at there. If your spouse died during 2008 or 2018, you may file a joint return with them for the current year, provided that you yourself did not remarry. And again, we don't need to be investigative reporters. So if someone said my spouse died mysteriously and 3 days later I got remarried, it sounds like a Lifetime movie. You don't have to worry about that. You can maybe refer them to the DA or whatever else, but we're going to still prepare the return with the information they provided. They are now going to file a joint return with their new spouse. Their deceased spouse is going to have a new filing status, and that's going to be married filing separately. We'll talk about that in just a second. Now, one of the other questions that has come up is same-sex relationships. For the past number of years, with the repeal of the Defense of Marriage Act, same-sex couples are recognized as married couples for purposes of income tax filing. Commonwealth of Pennsylvania recognizes same-sex relationships as well as a married relationship, so they will also allow you to file a joint return. So as long as the marriage was legally recognized and it's not a domestic partnership or other type of a relationship, it will be considered a valid marriage for federal and state purposes. Now, we sometimes have situations where people are married as of the end of the year and they don't want to be. That there are certain circumstances that maybe they're in the process of divorce or separation, that they may say, I'd like to file a return separately from my spouse. Now, we're going to caution against that for a variety of reasons. We're going to talk about that in just a little bit. But the problem with a married filing separately filing status is going to be very punitive in terms of the taxpayer. They're going to be losing a lot of benefits. They're going to be losing some opportunities they have for deduction and credit. As we saw from the very first slide, if you're married filing separately, you need to file a return if you have $5 of income, depending on what your other spouse has done. But a married filing separately is an option for taxpayers, and there may be some circumstances they want to file that way. One of the questions that may arise is someone may say, I don't want to file with my spouse because I don't trust them. Now, hopefully they just mean on the income tax return and not in general, because we're not licensed therapists. We don't have the opportunity to sit down and talk about their relationships. But if they say, I believe that there is something on the return, or I'm concerned that there may be something reported I'm not aware of. There are some options. It's outside the scope of VITA, but we do have resources we can direct people to for what we call an innocent spouse relief. An innocent spouse relief allows taxpayers who are not aware of any fraud that's been perpetuated on the return to be absolved of those liabilities. When you file a joint return, you're jointly liable for any of the obligations on that return. So if you file with your spouse and there's a balance due, the IRS is going to send a notice to both spouses to say this amount's due. They don't care who they collect it from. It's going to be a joint liability. So some people say, I don't want to file a return because I'm not quite sure that my spouse is going to be accurate in reporting information. Now, the innocent spouse provisions are a little bit more complex, but they do allow someone who's truly unaware of those types of situations to avoid being held accountable. But you truly have to be unaware. If you're signing a joint return and your spouse is reporting that they made $12,000 from their business, $12,000 is not a lot of money. But yet, you've gone on vacation 7 times in the past year, down to areas where the water is crystal blue, or you've gone skiing, or you've driven in cars, or when you go out to eat, the menus don't have pictures on them. You've been in areas where you understand that that's not going to be $12,000 worth of activity. You are no longer an innocent spouse in that case. You're aware that when you're showing up to the IRS audit and you're wearing furs, you're probably not innocent in that case. You knew that the money was coming from somewhere. You just didn't want to ask the question. But if you truly are innocent, if you had no knowledge of information on the return, there may be some opportunity for relief. One of the other areas that we see quite a bit is an individual may come in and say, I can't file a joint return with my spouse. I have to file separately. And the reason why is because my spouse has past tax liability. They have past tax debt. They owe student loans. They have back child support that's going to come out of our joint refund. And that is true. If you file a joint return and your spouse has a federal debt, they will take the entire amount of that refund and apply it to their outstanding obligation. However, there is a opportunity for us to change that. There is a form called an injured spouse form, and this is within the VITA context, the 8379 injured spouse form. And that would allow us to go ahead and split the refund between both spouses. And we've used this quite a bit in the past for people who may have run into circumstances where their spouse may have outstanding student loans, or they've had some situations and Mid-Penn has not been able to correct their outstanding tax debts yet. You can actually split the refund between the spouses. The IRS will still take the amount that is owed to them from the other spouse, but the injured spouse still gets their refund in full. So it is a form available within VITA. It may help encourage people to file a return together because that does actually boost the entire refund as a family unit. Now, when we talk about married filing separately, if they still say, I don't want to file with my spouse, we can still file married filing separately. We do need to have the spouse's information. You do need to report the spouse's name and social security number on the return. But we do probably want to mention to them that generally they're going to have a lot less tax benefit by filing as a separate return. Just to show you what that list looks like, this is a page that we have some problems with married filing separately. Loss or limited credits, a big one that now comes off the board. We had talked about why you want to file. We talked about the earned income credit. We talked about the child care credit, adoption credit, education credits. The earned income credit and the education credits are not eligible if you're married filing separately. You do not get those. So you do not get to take the earned income credit. You don't get the American Opportunity Credit if you're married filing separately. You also lose a couple other education benefits, including the ability to exclude savings bond interest from income. There's also student loan interest deduction that we'll talk about in a couple weeks. That's not eligible if you're married filing separately. A few other changes that occur if we'll talk about standard deduction. Those increase very nicely for a lot of taxpayers. If you're married filing separately and your spouse itemizes, you're required to itemize your deductions. Not a great situation to be in. A couple other things that we'll take a look at if you're collecting Social Security and you're married filing separately. Your Social Security is subject to a higher percentage of taxable income than you would be if you were married. Those percentages kick in a lot faster. There are some other issues that we run into, some IRA issues of contribution, deductions, that type of thing. So it's a fairly long list of why you probably don't want to file married filing separately unless that's truly your only option. We're not going to try and talk people out of it, but we just want to educate them to say, here are some of the consequences of filing married filing separately. Okay, we're ready for the big one. The one that everyone wants to file, the head of household. This is probably the nicest sounding one of all of them. If you took a look at the list and you're like, which one do I want to be? Head of household kind of pops up there, right? You know, this is my house. I get to control the remote. I can control the thermostat. You know, I say what's going to go happen in our house. This is what I am, a head of household. Now, but you have to meet qualifications. You're going to hear about head of household. You'll hear it on daytime talk shows about head of households is great status. Everyone should file head of household. Okay, not everyone should file head of household. Let's just try and make sure everyone's aware of that. Not everyone should file head of household. You have to meet these very specific rules to make sure you're head of household. So in order to file head of household, you have to meet some very specific tests. One of the first ones is you have to be a U.S. citizen or resident for the entire year. So I know here in Lancaster County, we sometimes do returns for individuals who might be somewhere along the path to citizenship or might be here on a temporary basis. Unless they were a U.S. citizen or U.S. resident for the entire year, they're not eligible for head of household status. So that's our first area that we take a look at. Second is we're going to kind of change our definition here a little bit. They're either not married at the end of the year, or the IRS has now introduced a new term for tax purposes only. This is not a legal term. This is not something you can go ahead and post out on social media, but you're considered unmarried. And we'll talk about what that means in just a little bit. There's a considered unmarried clause here. You have to pay more than half the cost of keeping up a home. So when we take a look at this, head of household. So the word household's in there. So we have to take a look at what household expenses are. You have to pay more than half the cost of maintaining the household to qualify. You also have to make sure that that home was the principal residence for at least more than half the year for either a qualifying child, so again, going back to the qualifying child rules, or a qualifying relative. And there are a couple small exceptions to that. If you take a look at your chart on B7, it'll kind of make a few indications that a head of household may be applicable if you're taking care of a parent and the parent doesn't have to live with you, but it is going to modify the qualifying relative a little bit. They take out the whole context. The person actually does have to be related to you. The person staying on your couch all year does not count as an individual for head of household purposes. So there are a couple exceptions to that rule. Going back to that considered unmarried. Now, this is a provision that we basically have termed in the past as an abandoned spouse rule. So if you have a situation where an individual is married, they're legally married at the end of the year. However, they're going to file a return separately from their spouse. They otherwise would be filing a married filing separate return. And for the last half of the year, the spouse did not live in the home. So what we take a look at is from July 1st through the end of the year, the spouse was not living in that household. So they're not there on a permanent basis. You're not having them come over for Thanksgiving and saying you want to reconcile and let them stay there for a bit. They're not in the home. So as long as they're not in the home for the last 6 months of the year, and the individual has kept up the home for at least half the year for the tax year, and they have one of the following individuals, that they either have a child, a stepchild, an adopted or foster child that they've been maintaining in the home for at least half the year, they can be considered unmarried. So they can actually move from a married filing separately status into a head of household. And the reason we call this abandoned spouse rule is typically you may see a situation in divorce where the couple will separate. They will be living in separate households. So if you have a situation where a divorce is not yet finalized, so they're still legally married by the end of the year, but the spouse living in the home is maintaining that home for at least half the year, providing more than half the cost of maintaining the home for one of the qualifying individuals we see here, that they can be now moved into head of household status. Much, much better than married filing separately. Now, that does not give the other spouse the opportunity to now file single. They must still file married filing separately unless they themselves could also qualify as head of household. So if you have multiple children, multiple dependents, actually both parties could be head of households as long as they truly have two separate homes and each one maintains it for at least half the year and provides for more than half the cost of maintaining the home. Now, one of the other questions we often get is, what does the cost of maintaining a home mean? And so we put this handy little clip art in the corner to remind you of what a home looks like. It's going to be basically the walls and the roof. Anything that's contained within there will be the cost of maintaining the home. So when we take a look at it, it's going to be things like your mortgage interest, your real estate taxes, your rent, any utilities, repairs, maintenance, property insurance, those types of things. Any food consumed in the home. So groceries you're bringing back. If you're going out to eat all the time, that does not count. Dining out doesn't count. We'll have to get some clarification on how Grubhub or other delivery services will work, whether it's food consumed inside the home. But we're basically looking at what are the things that you're providing for people to be able to be inside that home. What's it cost to maintain, to heat, to cool, to make sure the plumbing and electricity is working? All those things are considered costs of maintaining the home. All those household type of expenses. What's not included in maintaining a household are some things we may look at for support purposes. Things like clothing, transportation, life insurance, vacations, those types of things are going to be considered outside of maintaining the cost of a home. So those are not what we would consider. Now, the IRS does provide a chart, and this is going to be on B8 of your 4012. So if you do have a question about whether or not someone's providing more than half the cost of a home, the IRS has a very handy chart that will list all the items that they allow for determining whether or not you're providing more than half the cost of maintaining a home. We're going to have column A being the taxpayer, the amount that you paid. We're going to have the total cost in the second column. We add up column 1. If it's more than 50% of column 2, you're good to go. If it's not, you haven't provided more than half the cost of maintaining a home. So we just may want to take a look at the head of household status. Again, a lot of people may come in and say, I believe I'm head of household. Well, if you don't have a qualifying relative or qualifying child, you're not. So if you're home by yourself, you very well may be the head of your own household, but we're still going to put you down as single on the tax return. The other issue we take a look at is head of household will help you do a variety of things. It will help give you a higher standard deduction. It will help give you a different graduated tax rate structure than you would if you were single. Head of household does not give you any more dependents. It does not give you an additional child tax credit. It doesn't give you any additional American Opportunity Credit. So quite often, there may not be much of an actual tax difference between filing as single and head of household. One of the areas the IRS is looking at is to make sure that people are not taking head of household when they don't qualify. So we just want to be cautious as we go through to make sure that we're filing with the appropriate status. And again, when we take a look at the whole concept of providing more than half of keeping up a home, just to give you an idea, if you're filing for a specific address only one person per that address is providing more than half the cost of keeping up the home. We don't need to try and get creative and say we're going to take a house and we're going to start divvying out each of the rooms as different apartment numbers. Only one person typically will be responsible for the cost of maintaining more than half the upkeep of the home. So the IRS can figure out if we're using 5 people all claiming head of household for the same address. We just want to be sure we're doing this the right way. Okay, so wanted to kind of shift gears a little bit with the head of household, the one that a lot of people want to try and get into and talk a little bit about the one that most people don't even know about. And it's what we call the qualifying widow or widower. Again, this is going to be the longest definition. And part of the problem we run into is typically when you see this reported, we don't see the rest of the verbiage on this. It's not just a qualifying widow or widower. It's actually a qualifying widow or widower with a dependent child, with a qualifying child. So we need to go ahead and make sure that we take a look at those. Some people may say, yes, I'm a widow or widower. Let me go ahead and just check that status. And it's nice because you get you're effectively a single individual with a married filing jointly standard deduction. It's a pretty nice benefit to have, but it's a very specific circumstance. What we're looking at here is it's going to be a situation where you have an individual who was married and their spouse had passed away in the prior 2 years. So we're not looking at 2018. We're going to look at 2016 and 2017 to determine if that's when the spouse had died. We also have to take a look to make sure that the spouse was entitled to file a joint return for that year, which generally is not a problem. If they were married at that point in time, they were typically eligible to file a joint return. The spouse cannot have remarried before the end of the current tax year. So as long as they didn't remarry in 2018, they may still qualify for this special status. What we're going to do is we're going to change the definition a little bit. We still have that whole concept of paying for more than half the cost of maintaining a home, but now what we're going to do is this is going to have to be for the entire year, and we're going to change that qualifying child definition to be a little bit more restrictive. It's only going to be for the qualifying child or stepchild. Grandchildren don't count in this context. Foster children don't count in this context. So if you're a qualifying widow or widower, the dependent child has to be your own child or your adopted child. It can't be a grandchild or foster child. So just one of those little changes we have in the tax code. If they qualify, this is a tremendous opportunity for individuals. Generally where we may see this is if you have a married couple and one of the spouses has passed away, generally unexpectedly through some sort of accident, incident, those types of things where they can actually qualify. And what's going to happen is they can file married filing jointly in the year of death. For 2 years following, as long as they have a qualifying dependent, they can file qualifying widower with a dependent child. And then after that, they may be eligible for head of household. So one of the things we always have to walk through, some people may come in and bring a prior return with them and say, I have always filed this way. We always have to make sure that we're taking a look at each year on its own. Status may change. There may be a different filing status than what they had in the years before. So you always just want to go through this with the client, making sure we have the right filing status. So the good news is this is probably one of your toughest decisions to make on a return. And we have a lot of flow charts that help you through it. And we'll go through some practice examples in a little bit here after our break. Now, I just want to kind of mention just a few other quick things before we kind of break here. One is going to be a unique filing situation. Again, what we have in Lancaster County, we have a number of individuals who are in transition with citizenship or maybe here on some non-resident type status. Now, we know if you're a US citizen, you have to file an income tax return. Now, there are some differences we have between resident aliens and non-resident aliens. If someone's a non-resident alien, basically means that they have not gone through a process of immigration necessarily yet. And we'll talk about the non-resident alien in just a little bit. If you are a resident alien, you're going to be treated as if you are a US citizen for tax purposes. You're going to be treated exactly like every other US citizen in terms of requirement to file a return. You're going to have the same opportunities for filing status. You're going to have the same rules for dependency. There are a couple returns we can't work with. If an individual comes in and they're here on a visa, and the visa would have to be a code F, a J, an M, or a Q, so there'd be some specialized work visas, potentially an educational visa or a temporary visa. Those are going to be outside the scope of VITA, and we can't handle those returns here. Generally, we try and make sure that they're screened out before they come in, but every once in a while, you may have someone to say, oh, by the way, my neighbor has a visa and they have some tax issues, can we help them out? If that's the case, go ahead and refer them to the site coordinator. We'll kind of get them up the chain to go ahead and see how we can best direct those resources to the appropriate parties. But now what we're taking a look at is kind of the whole concept of resident versus non-resident alien. And again, the resident aliens are going to be treated just like they would be if they were US citizens. They're going to be taxed on all their worldwide income. They're going to be filing a traditional 1040. We're going to go through a couple different areas. A non-resident alien is going to be filing a 1040 NR. It's a specialized form. And we don't actually have the ability within VITA to prepare the 1040 NRs. So that's going to be outside scope as well. Where we may see those arise is we may have people who are refugees that are here and they're not in a path to citizenship yet. There may be students that are here on a variety of purposes that would be considered a 1040 NR. If we have undocumented workers, they would actually be a Form 1040 NR. And unfortunately, those are going to be outside the scope of VITA as well. Now, in order to help determine whether someone's a resident or non-resident alien, there are two main tests that we take a look at. And again, when we take a look at what we normally think about for purposes of clear description and definition, the first test we have is a green card. If any of you are not aware, this card is no longer green. They kept the name. They keep calling it a green card, but it's no longer a green card. It's simply a card that they're going to have. It's a valid alien registration card. Typically, if you have one, you know that you have one. You have worked hard to make sure you get the green card. There are certain restrictions that you have to be able to preserve that green card. So if you talk to an individual and you ask, are you a US citizen? And they say, I am not, I'm a US resident. I'm a resident alien, here's my valid alien registration card. That's effectively going to treat them as a resident for US tax purposes. We'll file a traditional 1040. The other test that we have is what we call a substantial presence test, and this will be notated in your 4012 on page L1. The substantial presence test means that they've been here in the US for a significant period of time. We're going to take a look at the current tax year and the prior two to determine the number of days that they've been here. The one restriction we have is if this is the first year that they're trying to qualify under a substantial presence test, we can't do it under VITA. But if they come in and they say, I've been considered a US resident alien because of the substantial presence test, then we can go through the process. The first year is a little bit tricky because there can be some issues with dual nationality and a couple other issues. So we can't deal with those issues within VITA. But for those of you who have never prepared a return before, don't worry that all of a sudden you're going to get bombarded with questions about visas and non-resident alien status. A lot of those are already screened out before. If you do run into an issue, feel free to contact your site coordinator. If we have other issues, we're still going to move that up the chain to determine how we can handle those situations. One other thing I just want to mention about these scenarios when we talk about non-resident aliens or someone with different types of identification numbers, generally all of our taxpayers will have to have a social security number. So if you're a US citizen, you'll have a social security card that we ask to see when we prepare your return. We're going to be using that as your primary identification number. Individuals who have not been granted a social security number will have what we call an ITIN. It's basically what we take a look at as an individual tax identification number. That's going to be issued by the US government. If you have an individual who is adopting a child and the foreign adoption is in process, they will typically have a ATIN, which is an adoption tax identification number. All of those are valid numbers to have on a return. One situation we may run into, if an individual has an ITIN, they're here and they haven't been given a social security card yet, but they are working, they may actually be given a card that says social security card valid for work purposes only. It means that they are actually going to be getting a W-2. They're not collecting social security yet, but they're getting a W-2. That W-2 will probably have a weird looking number on it. It's not going to be their ITIN. We don't want to put the return down using that number off the W-2. That's just a placeholder. We're going to use the individual, or basically the individual tax identification number, the ITIN, as a primary identifier, and we're just going to simply enter the W-2 as shown. Once the system knows it has an ITIN in, it's going to allow you to input the W-2 without a problem. It's not going to try and correct it, and we're just going to go ahead and prepare the return that way. Just as a reminder, if you have an ITIN, you're not going to be eligible for the earned income credit. So you have to have a valid social security number to be eligible for the earned income credit. And likewise, dependents with an I-10 are not eligible for the child tax credit. So we do have to file returns, but they're not eligible for the EIC or for the child tax credit.